Canada lost 18,000 jobs in April, but the headline number is actually the least interesting part of this morning's StatsCan report. The story underneath it tells you something specific about where this economy is breaking and who's getting hurt first. Good evening, I'm Steve, and this is the Daily Brief Canadian Macro. Statistics Canada dropped the April Labour Force Survey this morning, and today we're giving it the full breakdown. Not just the number everyone's going to talk about, but the composition, the geography, the demographics, and what it means for the Bank of Canada's next move. 3 segments today, all from the same report, all pointing to the same thing. Let's get into it. The top line, Canada shed 18,000 jobs in April. Analysts had called for a gain of 15,000. That's a 33,000 job swing in the wrong direction. And the unemployment rate moved up 0.2 to 6.9%, a 6-month high, with 1.566 million Canadians now out of work. But here's what the headline doesn't tell you. This was almost entirely a full-time job story. Full-time employment fell by 47,000 in April. Part-time picked up 29,000, which softened the net number. But what that composition tells you is that the jobs being added are not equivalent to the jobs being lost. You don't replace a full-time manufacturing or construction position with a part-time service shift and call it even. Zoom out to the year. Canada has now lost jobs in 3 of the first 4 months of 2026. Full-time employment is down 111,000 positions since January. The March gain everyone celebrated turned out, in BMO chief economist Doug Porter's words, to be a false dawn. The underlying tone in Canada's labour market is deteriorating, and it has been since the start of the year. One more number we're sitting with, the employment rate, the share of the population aged 15 and older who are actually working, has dropped to 60.5%. That matches the recent low from August 2025. We're not recovering ground, we're actually retesting the floor. The provincial breakdown is where this report gets genuinely interesting, because the losses are not evenly distributed, and the pattern tells you something about what's actually driving this. Quebec shed 43,000 jobs in April. That is a significant number. Nearly the entire national decline came from one province. Quebec's unemployment rate jumped 0.8 of a point to 6.2% in a single month. Newfoundland and Labrador lost 5,200 jobs and are now sitting at a 10% unemployment rate. Saskatchewan and New Brunswick also posted declines. Ontario was the outlier, up 42,000 jobs, with unemployment edging slightly lower to 7.5%. That number needs context, though. Ontario's unemployment rate is still the second highest among the major provinces, and the gains were concentrated in services, not the goods-producing sectors like manufacturing. Alberta is worth watching closely. Employment was essentially flat on the month, but the unemployment rate jumped half a point to 7%. More Albertans entered the labor force looking for work, a signal of confidence in finding a job, but that optimism is colliding with a labor market that isn't absorbing them. The sector story reinforces the geography. Goods-producing industries, construction, manufacturing, and resources lost 26,800 jobs in April, but what the chart shows clearly is the rotation happening underneath that number. Everything losing jobs is capital-intensive or discretionary, like culture and media, construction, and personal services. On the opposite end, everything gaining is defensive or government-adjacent, like healthcare, support services, and accommodation. That is a textbook slowdown rotation, and it tells you something about how businesses are positioning right now. Here's the tension at the center of this report, and it's the one that matters most for Canadian investors. Wages are still growing, but the labor market is softening. Those two things are pulling the Bank of Canada in opposite directions at the same time. Average hourly wages were up 4.5% year over year in April to $37.70 an hour. That sounds like inflation pressure, but StatsCan's own composition adjusted figure, which controls for the fact that more experienced workers now make up a larger share of the employed population, puts underlying wage growth at 3.4% and decelerating. It was 3.6% in March and 3.5% in February. The trend is cooling. Looking at late 2025, especially June, September, October, Canada was consistently beating forecasts by wide margins. That's what was giving economists in the Bank of Canada more confidence heading into this year. Then 2026 started and the floor dropped out. 3 of the 4 months this year have missed to the downside. The cumulative swing is 112,000 jobs below where we were expecting to be. That late 2025 optimism wasn't wrong exactly. The data really was strong, but it created a baseline expectation the labor market has completely failed to sustain. And here's who is absorbing that failure. Youth unemployment. Canadians aged 15 to 24 jumped half a point in April to 14.3%, Core-aged men, the 25 to 54 cohort that anchors most household balance sheets, rose 0.3 to 6.1%. What makes this particularly telling is what's driving it. The layoff rate is actually holding at pre-pandemic norms. Companies aren't cutting people en masse. What they're doing is not hiring. This is a confidence freeze, not a collapse. Businesses are pausing forward decisions, and the people who need a door to open, young workers, workers re-entering, workers switching, are finding those doors closed. That is a more insidious kind of labor market weakness than a spike in layoffs, because it doesn't show up dramatically in any single number. It accumulates, quietly, month by month, in participation rates and youth unemployment and the slow erosion of household formation. CIBC's Andrew Grantham put it directly this morning: increasing slack in the labor market limits the ability of energy price shocks to spread into broader inflationary pressure. BMO's Doug Porter graded the April report and said it's incredibly tough to see the logic behind market pricing of rate hikes later this year. CIBC now expects no cuts and no hikes through all of 2026. For investors, the practical read is this: the Bank of Canada is boxed in. A softening labor market argues for cuts. Oil price volatility and global inflation risk argue against them. The most likely path is continued holding, which means borrowing costs stay where they are, housing stays where it is, and the pressure on Canadian consumers continues to grind. The loonie is the variable to watch. A labor market that is visibly weaker than expected, combined with a central bank that can't cut without risking inflation, is not a currency strengthening combination. Well, there's three things to take away from this morning's report. First, the composition matters more than the headline. Minus 18,000 jobs is bad. Minus 47,000 full-time jobs, offset by 29,000 part-time job increase, is a different and worse story about the quality of work being created right now. Second, this is a tariff story as much as it is a labor story. The sector shedding jobs. Good producing industries like construction, manufacturing, are exactly the sectors that would pull back investment and hiring when trade policy is uncertain. The data is consistent with what you'd expect to see if Canadian businesses have been quietly pausing decisions since the start of the year. Third, the Bank of Canada is effectively paralyzed. Weakness argues for cuts. Inflation risk argues against them. The hold is the path of least resistance, and that means the adjustment is going to fall on the currency and on consumers rather than on borrowing costs. Well, that is your daily brief for today. If you found this video helpful, please subscribe, hit the notification bell so you don't miss our next brief, and don't be afraid to comment if there's another macro topic you think deserves a highlight here. I'm Steve. As always, nothing here is financial advice. Everyone's situation is different, so please do your own research and talk to a qualified financial advisor before making any investment decisions. Good night.